What's up guys, it's Wiz. Welcome back to the channel. If you're new, I'm a Canadian investor. I cover a whole lot of information about investing in Canada and do research into our Canadian market. I dive into growth investing, dividend investing, and Canadian small cap / penny stocks. Today we'll be going over 3 top performing Canadian dividend stocks that offer excellent buying opportunities. For new investors, you need to join Wealthsimple Trade if you're looking to start investing and live in Canada. If you use my link in the description below to join Wealthsimple, you get $25 for free to begin investing. After a tough start to this month, the Canadian equity markets have rebounded strongly over the last few days due to easing recession fears. Amid renewed investors' confidence, the S&P/TSX Composite Index is up 9.9% this year. Meanwhile, the following 3 stocks, which I'll be going over today, which pay dividends at a healthier rate, have outperformed the broader equity markets. These 3 dividend stocks offer excellent buying opportunities given their solid underlying businesses, consistent dividend increases, and healthy growth prospects. Fortis, ticker symbol FTS, operates 10 regulated utility assets across the United States, Canada, and the Caribbean, meaning the electric and natural gas needs of 3.5 million customers. The company operates a capital-intensive business. Falling interest rates could lower its interest expenses, thus improving its profitability. So the company has witnessed healthy buying over the last couple of weeks, with its stock price rising around 12.5% higher this year. Given its regulated asset base, Fortis generates stable cash flows, thus allowing it to raise dividends for 50 consecutive years. It currently pays around 0.59 cents per share of quarterly dividends, with its forward yield at 4%. Moreover, the company has adopted a $25 billion 5-year capital investment plan, which it plans to invest from 2024 to 2028. These investments would expand its rate base at an annualized rate of around 6.3% through 2028, thus supporting its financial growth in the coming years. Amid its growth prospects, the management is confident of raising its dividends by 4 to 6% annually through 2028. Considering its consistent dividend growth, regulated asset base, and expansion initiatives, I believe Fortis would be an excellent addition to your Canadian portfolio. Second on my list would be Enbridge, ticker symbol ENB, which is trading around 17.7% higher this year amid solid second quarter performance and falling interest rates. During the June ending quarter, the company generated an adjusted EBITDA, earnings before interest, tax, depreciation, and amortization, of $4.3 billion, representing an increase of 8% from the previous year's quarter. Besides, its dividend cash flows increased by 3% to $2.9 billion. The midstream energy company has completed the acquisition of 2 natural gas utility assets in the United States and expects to close the 3rd deal this quarter. Further, it continues strengthening its midstream renewable and utility assets through a $24 billion secured capital program. These growth initiatives could boost its financial in the coming years. Meanwhile, Enbridge has been paying dividends non-stop for 69 years and has raised its dividends for the previous 29 years at an annualized rate of above 10%. It currently pays a quarterly dividend of around 0.915 cents per share, which is forward yield around 7%. So basically, Enbridge would be an enticing buy right now, and it should be one of those companies, tickers, stocks that should be on your watch list if you don't have it already in your Canadian portfolio. Another top dividend stock that has outperformed the broader equity markets is Canadian Natural Resources, ticker symbol CNQ. The oil and natural gas producer is up 14.8% this year amid elevated oil prices and solid quarterly performances. In the June ending quarter, the company's adjusted net income from operations and adjusted fund flows grew by around 50.6% and 31.8% respectively. Increased production, effective and efficient operations, and higher realized prices drove its financials. Meanwhile, CNQ has planned to invest around $5.4 billion this year, with $2.5 billion in conventional exploration and production and $2.9 billion in thermal and oil sands mining and upgrading. These investments could continue to drive its production. Further, analysts are projecting oil prices to remain elevated in the near to medium term, amid growing demand, geopolitical tension, and supply concerns. Moreover, with its debt levels falling below its guidance of $10 billion, CNQ will return 100% of its free cash flows to its shareholders, meaning dividends, right? So making its future dividend payouts safer. The company has raised its dividends at around CAGR of 21% for the previous 24 years, while its current forward yield stands at around 4.3%, which is still a great return for a company like this one. Hopefully you enjoyed my latest update of these 3 Canadian companies. Make sure to always do your own due diligence before investing into any of the mentioned companies. Let me know in the comments if you have any questions, since I really want to expand my own knowledge in the Canadian market and you also expand your own knowledge by asking questions. It's a win-win situation. If you did enjoy this video, leaving a like really helps grow the channel. Thanks for watching. I'll see you guys in the next video.